Good morning, and today is the 19th of August, and this is your Two Grey Beards update. So, Andy, hi, and last week I think was very much what we thought it would be.
Yeah, I think it's been hello, how are you? I think it's been pretty much the same way since the QRA came out in on July 31st and August 2nd, and we're just playing that out with assets performing badly across the board.
Yeah, I mean, absolutely every single asset has gone down, and as you can see on the chart that we're showing you, there isn't anything that's up, and everything is continuing lower. As far as what happened last week, apart from the continued sell-off in assets, we had very little data, didn't we? We had retail sales, we had some unemployment, we had the FOMC minutes, but nothing was weak, and therefore there was no solace for bonds. And as bonds sell off, so they pressure equities, the multiplier effect. The multiplier gets squeezed and equities go down. Whatever the earnings are, it's not really important. The multiplier is far more important.
Yeah, and I think so. In terms of the data, I think the only thing I noticed in the FOMC minutes was they did add one bit of language to quantitative tightening, which sort of institutionalized the idea that quantitative tightening is going to happen even if rate cuts begin, which it wasn't news, but it was and is consistent with what they've been saying. So, but that was the only thing I noticed. I think what we had is just assets weakening. The equity market actually, in my view, behaved fairly well because the economic data was fairly strong. The earnings that had happened at the beginning of the week and prior weeks were fairly strong. Retail sales were very strong. And so, equity earnings are still supported while it's mostly been a multiple contraction and not a particularly bad one for equities. They may have a little bit of catching up to do on the downside, but you know, there'll be wiggles along the way.
Yeah, absolutely. And as far as what is out next week, we've got, again, a light calendar in terms of economic numbers. We just have some PMIs and durable goods, the usual stuff that comes out. We have the 20-year auction, then we have 30-year tips, nothing extraordinary. The two interesting things are going to be Nvidia earnings on after the close on Wednesday, and of course Powell on Friday at Jackson Hole. Maybe we should say a couple of words about that.
Yeah, sure. So, I mean, mostly we want to hear what he has to say before we make any strong changes of an opinion. But what I would say is that they're basically three expectations. He declares victory, which we think is a low probability. He suggests there's quite a bit more hiking along the way, which is, again, I don't see why he would at this stage. And then there's what I think is the most likely outcome, which is he's thinks we're close to the end, but we're going to pause for a very long time.
Yeah. And that probably is not how the market is positioned. I think this market is still positioned for a relatively early start to cuts and deep cuts once they start. So the market could very well be disappointed in terms of what is forthcoming in 2024 from the Fed, if anything. The real surprise would be for him to say, guys, don't expect anything in 2024, because even when we get to terminal and we stop hiking, that doesn't mean that we're going to cut, not for a long time.
Right. Yeah, I mean, the agenda for the overall Jackson Hole conference, which is once a year, happens around this time, and there's quite a bit of. And last year, for instance, there was a very meaningful speech. The agenda is more modest, and I think the news will be more modest. And the agenda's about the change in the economy post-COVID in a structural sense, and the idea that restrictive interest rates are or the neutral interest rate is higher than it has been. And so that would fit in with a speech that supports pausing for a long time.
Okay. Well, we are not going to change our macro outlook, are we? But what we can do is say a couple of words about where we see value in bonds and equities and where we would deploy the mountain of cash that we have in terms of percentage allocations.
Sure. Yeah, I mean,
So,
I think the first thing you do is start with the yield curve. And, we think there's a lot of pressure due to the supply, but, there has been a fairly big move already. We've gotten half-ish about of what we would have expected from this supply shock that was announced on in early August, in that tens have rallied, yields have risen on tens about 30 basis points and 40 on 30-year bond yields. And I think that's about halfway there. And so, around 460 and around 475 for round numbers, that's sort of where I would think now it may take time because the supply, there's the front running of this big news, and then there's the supply that actually comes. So it may take time, but that's sort of the place I'm looking at as sort of the destination.
I agree. I mean, if one looks at historically where yields have had resistance to going higher, we haven't been higher than 458 in tens for a long time. And I think that, around the 450 area to 460, as you mentioned, represents value. I think the yield curve is unlikely to be flat at such a high level, in which case anything around 450 represents value. But then, you start looking at equities and where we are in terms of multiples, and one has to say, well, are earnings going to really reaccelerate here, or are they likely to remain stable at best? And if earnings are stable at best, if bonds do go to around the 4.5 area, as we've suggested, then the multiplier being much higher than 17 really makes not a lot of sense. And in that case, you're looking for value around the 4,000 to 4,100 area. And that is where I think that we should deploy our cash and be ready to deploy cash. But really, here at 4,400, it's still far too soon and far too high, I would say.
Yeah, I agree. I mean, I think those things hold together. 460, 475, 30, or whatever it is, and a 4,000, 4,100 S&P sort of, that gives you both sensible multiples and reasonable risk premiums and reasonable break-even inflations and reasonable real rates. And that's sort of a nice place to be. And then we see how the economy plays out and whether there is, earnings hits or not. And those will guide us once we get to those levels.
I think that we have our game plan. Basically, we wait for Powell, see if he says anything which is of interest. If we get something, we will shoot an email to you or we'll do an emergency video. And in the meantime, we just keep on enjoying the 5% that we are compounding at in cash and stay at minimum equity allocation, wait for bonds to get to around the 4.5 level, and then decide to deploy. I
Sounds
think we
great.
have our game plan.
Yeah, absolutely.
Have a wonderful week.
See you next week.
Bye bye. Well, as you just heard, absolutely no change to our allocations. We are at minimum in equities. We don't have much in bonds. We don't like duration yet. Not until 4.5% in tens, and then we can deploy some money. Basically, all assets are going down in value, and apart from cash, naturally, which is wonderful. And we're going to remain patient. We are going to keep on waiting for the market to hit our levels and then deploy. Now, we could sell some puts in some short-dated puts in equities on the way down, but we're not going to do that simply because you get far too little for your money as yet. Volatility has not risen enough, in our opinion. So we're not going to do that. We much prefer to wait for Powell and then send you a summary of what he said and potentially an email with trades or an emergency podcast, as we said. All these other things are updated. The broker statement is updated so you can see where we are and nothing done. And finally, absolutely no orders again. We will remain patient. We think this is a long-term opportunity to wait and pick up assets at reasonable valuations and then ride them for a long time. Thank you very much indeed, and enjoy the weekend.